So let's start. So this template works with Forex peers from investing.com. Investing.com. So for you to check the volatility for the peers, you would have to go to Tools, Forex Volatility, and this section will pop up. The default is 10 weeks, and I use the default. So over the past 10 weeks, what is the average daily range for each one of these pairs? And then once you're here, you could just copy this and then drop it in the template. Forex volatility. Right. Paste text. Okay. And then this is going to generate. We don't need this one here, so we could delete that. Move this section up. That section up. We could copy this over here. Notice I made a highlight on gold. I'll show you more about that in a few. Delete that. And then sort by volatility. What did I sort by? Was it volatility? I believe so. So the second one, pips, that would refer to the volatility. You start from largest to smallest. Gold. So I had a highlight on gold. Let me just adjust this. I highlighted gold because the volatility on gold is measured in points, and for you to convert it to pips, you need to divide it by 10. So this 3091 is actually 309.1. So you just make that adjustment manually. And I highlighted just to make a note that that was adjusted manually. Then the pip value, this will not change. So you don't have to update this section. So you put in the Forex volatility and you get the pip value. Those are the inputs. And all of that runs into this risk calculator. The sections that we have in cream color. So these sections here, these are your inputs. So for now, I just have all of the pairs that we would trade listed in here. And you could change these values based on what you're working with. So if you have an account size of $300, you could plug that in there. And then this is going to show you the things that you're interested in would be your lot size, your stop loss, and your take profit for each one of these pairs. So for gold, if you're trading a $300 account, your lot size would be 0.01, your stop loss would be 47 pips, and your take profit would be 93 pips. So if you're looking at the setup, and when you put these parameters on your chart, if it exceeds what you have, then you shouldn't be trading. So for this setup, the stop loss here was 43 pips, right? 43 pips is less than 47 pips, so this is an acceptable trade for you to take. GBP NZD, 0.02 would be your lot size when you're trading it. And the reason we're changing the lot sizes is because we want to maintain a standard risk as we're trading different pairs. We do not want, when you're trading gold, your loss to be major, and then when you're trading a smaller pair, your loss will not be as big. We want to maintain it at an equal level. So the risk and the reward will always be the same. In this case, the risk would always be $3 and the reward would always be $6. Another thing that you should keep in mind, you should always trade as if you have a smaller account than what you're actually trading with. If you're trading with a $600 account, for example, then in this tool, you should put in like $300 because you still have to cater for losses. And if you're trading as if you have a $300 account, when you actually have 350, for example, because you had some losses, then it's going to affect your risk level, right? Because $3 from $100 is 3%, whereas $3 from $300 is 1%. So that would be over leveraging your account. So you should trade as if you have a small account. So if you have a $600 account, as in the example I was giving, trade as if you have a $300 account. If you have a $100 account, you notice gold shows here your lot size is 0. That is because you should not be trading gold on a $100 account. Your account is too small. You don't have, even if you're trying to use the smallest lot size, it will not be small enough to trade the $100 account. You'll be over leveraging. So that's why with a $100 account, you will see 0. If you're trading a $500 account, you're still using 0.01. If you're trading a $1,000 account, then you could start using 0.02 for gold. And gold is the highest volatility, so gold will have the lowest lot size. Because it's also the highest volatility, it will have the highest stop loss and highest take profit. But it doesn't matter the lot size, stop loss or take profit that you're going to be getting from here. The formulas caters for it to always risk the same amount. The risk and reward will always be the same, so it balances out your risk management for you. All right, so let's say today you were looking at gold, right? Boom, boom, you see what you need to see. Your clear W, you wait for the New York session. I didn't wait for the New York session on this one. I saw the W, I took it, but then when the New York session opened, they came back down to this level, and then they started consolidating here a bit before moving up. But if you mark up your chart, right, and you know that you're trading gold, and you would like to now go and enter your trade, you come in here and you click on gold. This section helps you to easily go through and select whichever pair you're trading, and it's set in alphabetical order. So AUD pairs at the top, CAD, CHF, Euro, XAU, USD will be at the bottom, right? So you're trading gold. Instead of having to come here and sort through all of these to find your pair, you could just scroll through and select whichever pair. Let's say we were trading EUR/JPY, right? EUR/JPY, we know that would be somewhere around here. So EUR/JPY, where is it? EUR/JPY. So instead of having to come through here and look, where is EUR/JPY? Right, you have this tool up here. You just scroll through, find it, and then this generates your lot size that you should be using and what is your stop loss and take profit that would be acceptable for that pair. Right, so you could then just go on your chart, put in your long position tool or your short position tool, and then see if the risk is acceptable based on your risk management plan for that account size. The stop loss and take profit, I set this as 15% and 30%. You could change this if you like, but my logic behind this is for every pair, I'm considering the volatility. So the volatility will tell you typically how much will this pair move within a given day. Gold typically moves around 300 pairs over the last 10 weeks. So I know that if I'm trading gold, it's likely that it's going to move around 300 pips. Right? So my stop loss that I'm setting for gold is going to be 50% of that 300 pips. Right, which comes up to around 50 pips, and 30% is what I'm going to try to set as my take profit, which is going to be 93 pips. Now, if you're looking at this, the stop loss here is 43, which is below this stop loss pips that I have here, which means that it's acceptable. And if you're looking at how much is it, 93, right? If you're looking at 93 pips, it's a 2-to-1 ratio minimum, right? 93 is around here, right? So this is a reasonable risk to reward. And the same would apply for the other pairs. So if you're taking a gold pair, like let's say you had a setup, let me pull over here. If you had a setup that looked like this, and then you had a W, then you had a second leg W, maybe a long railroad track, and you put in your tool, long position tool, and you realize that this stop loss level is 66 pips, which is above what is acceptable risk. You should stay out of that trade. Don't try to push it. Stick to things that are within your acceptable risk level, and be very selective about your trades. Of course, you would have to have your trading plan. So have your trading plan in place, and then apply these risk to reward metrics that we have in here. So this tool will help you to no longer have to guess, okay, it's a euro pair, I should probably risk 20 to 30 pips. You have a more precise measurement of how many pips you should be risking on each pair and what lot size you must be using based on your account size in order for you to balance out your risk. And it's very simple for you to just select through whichever one and punch them into your MT4, MT5. The risk to reward that we have here is 1 to 2. So we're risking 1% of the account per trade, and we are looking to collect 2% of the account if we win that trade. Right, so if you have a trading plan, you've tested your trading plan, you know your win rate for that trading plan, then you come and apply this risk management aspect to it. It's going to help you with your effectiveness at trading. So that's it for this section. The probability model that I built here is after you would have completed your back testing and you have an idea of how effective you are. If you look at your MT4 results and you see that 50% of your trades hit take profit, right? And you lose 50% of your trades. You will not win all of your trades. That's the first thing you need to accept. Somebody was asking me, because I was helping them with their trading plan, and they were asking me, all right, so I lost this trade, what do I need to look for? I'm like, no, just accept the trade. Everything about your setup was good. There isn't anything there that was out of alignment. The reason you were stopped out is because the market makers are looking for money. They didn't have enough money, so they went against you. It just stopped, and then they accumulated up there. So just leave it. Those things will happen. Even Goldman Sachs, like this video that I was showing earlier, they have losses, right? 38 losing days, 212 winning days. And these persons, they have a lot of information, a lot of knowledge, a lot of money, and they're still losing 38 losing days. So this is the reality of trading. You will lose. But even if your win rate is 50% and you're going at a 1 to 2 risk to reward on a $300 balance, this gives you an idea of how your account will either grow or decrease over 100 days, 100 trades, period. Right, so at 50%, I could just keep regenerating this and it would show this is the probability.
For Davis?
Right, if you have, let's say you had a 30% win rate, right? You're winning 30% of your trades. Then this is the probability. And this graph shows whether your account balance is going to go up or go down. So in this case, there it's going down. So it is still possible that with a 30% win rate at a 1 to 2 risk to reward, you could still be in profit. It's possible, right? But is it probable? It's not, the probability is not in your favor. So if you do your back testing and based on your trading plan, based on your discipline, you're able to achieve a 30% win rate, should you go live? You shouldn't go live. If you have a 50% win rate, it's more likely that if you go live with the same discipline, the same trading plan, the same risk to reward, you would be able to be profitable. The probability is in your favor. If you have a 70% win rate after you do your back testing, the probability is more in your favor that you will be growing your account. 80% win rate. Notice how the probability model is almost always Actually, it's always, not almost, it's always up with the 80% win ratio at 1 to 2 risk to reward, 90% win rate. All right, so after you do your back testing, this is where you could plug your value into the probability model. By using this probability model, you won't have to now think about how likely is it. You could already have an idea of how likely it is. So do your back testing, find out what is your win rate, and then using this, you would know that, is it okay for me to go live? It's not okay for you to go live if you're at 30%. If you're at 50% and you're going live, you're still pushing it, right? Because this is assuming that you maintain that discipline, that you're following that trading plan. It means you're operating like a robot, right? Which is highly unlikely. We're humans and things are going to come up and it's going to throw off balance. So 50% is still, I would not recommend that you go live with a 50% win ratio. 70% win ratio is what I would recommend most likely, because you're still catering for cases where you're going to scratch out. You're still catering for cases where you're going to not following your trading plan for a day and lose, over leverage or something. 70% would be better. That would be my advice. That's it for the review. Do you guys have any questions?
No, not none at this time.
No questions.
No.